Imagine waking up tomorrow morning. You pour your coffee, you open your phone, and you see it. The US dollar has lost 30% of its value overnight. Gas prices have doubled. Your savings account, gutted. The stock market, in free fall. Grocery shelves begin to empty by noon. It sounds like the plot of a Hollywood thriller, but here's what no one in Washington wants to say out loud. China already has the weapon to make this happen. And it's been sitting there, loaded and ready, for over 2 decades. To understand the weapon, you first need to understand the relationship. The United States and China are bound together in what some economists call the most dangerous financial codependency in human history. On one side, the United States, the world's largest economy, home of the reserve currency, a nation that has run a trade deficit for decades, meaning it imports far more than it exports. To fund that deficit, to fund its wars, its highways, its Medicare, its debt, the US government borrows. It issues Treasury bonds, and it needs someone to buy them. On the other side, China, the world's factory floor. For decades, Chinese workers assembled the world's goods, iPhones, furniture, clothing, electronics, and shipped them to American consumers. In return, China accumulated trillions of US dollars. But you can't just sit on trillions of dollars. You need to park them somewhere safe, somewhere stable, somewhere that pays interest. And so China did what any rational actor would do. It bought US Treasury bonds. At its peak, China held over $1.3 trillion in US government debt. Think about that number for a moment. $1.3 trillion. That's more than the entire GDP of Australia, more than the annual budget of most countries on Earth, held by a single foreign government, in American debt. This arrangement seemed to work well for everyone, for a while. America got cheap goods and cheap financing. China got jobs, growth, and a safe place to park its wealth. But beneath the surface of this seemingly symbiotic relationship, a quiet question was always lurking. What happens if China decides to use those bonds as a weapon? Before we get to the weapon itself, let's understand the ammunition. A US Treasury bond is essentially a loan that you give to the American government. You hand the government your money today. They promise to pay it back later, with interest. These bonds are considered the safest investment on Earth. For one reason, above all others, the United States has never defaulted, not once, in over 200 years. That reputation, that credibility, is the bedrock of the entire global financial system. Here's why it matters so much. When investors around the world get nervous, when wars break out, recessions hit, or markets crash, they don't run to gold first. They don't run to the euro. They run to one thing, US Treasury bonds. During every major global crisis of the past 50 years, 9/11, the 2008 financial crisis, COVID-19, global investors fled to the dollar, not away from it. This is the paradox at the heart of American power. America can borrow essentially unlimited amounts of money because everyone trusts it. And because it can borrow, it can fund its military, its social programs, its global influence, at interest rates far lower than any other country on Earth. The dollar isn't just a currency, it is the operating system of the global economy. Now, here's where China enters and where things get dangerous. China holds hundreds of billions of these bonds, and at any moment it could choose to sell them, all at once. Imagine the effect. China dumps its entire treasury portfolio on the open market. The supply of bonds skyrockets overnight. When supply surges and demand stays flat, prices fall. When bond prices fall, interest rates rise. That's just math. It's built into how bonds work. And when US interest rates spike suddenly and violently, the entire American economy begins to seize up. Mortgages become unaffordable. Corporations can't refinance their debt. The government suddenly has to pay far more to borrow, diverting money from everything else. The stock market reacts. The dollar weakens. Inflation roars back. In the most extreme scenario, a fast enough, large enough sell-off could trigger a dollar crisis, a loss of confidence, a cascade, the kind that ends empires. This isn't theoretical. There have been moments in history when this weapon nearly left its holster. In 2007, He Fan, an official at China's state-owned Academy of Social Sciences, made a statement that sent quiet shockwaves through Western financial circles. He warned that if the United States continued pressuring China on trade, Beijing had the option to trigger what he called a nuclear option, a mass sell-off of US dollar assets. The phrase nuclear option appeared in Western financial headlines within hours. The US Treasury did not publicly respond, but behind closed doors, the implications were crystal clear. For the first time, a Chinese government official had publicly acknowledged the weapon's existence. When the Trump administration launched its trade war against China, slapping tariffs on hundreds of billions of dollars worth of Chinese goods, Beijing faced a choice. It could retaliate with tariffs of its own. It did. But many analysts expected a more dramatic move. Why not sell treasuries? The answer, in 2018, was nuanced. China had already quietly been reducing its Treasury holdings from a peak of $1.3 trillion in 2013 to under $1.1 trillion by 2018. Whether this was strategic de-risking or economic necessity, the message was not lost on Washington. China was slowly, methodically, quietly disarming the mutual dependency. Or was it repositioning for something bigger? When U.S. House Speaker Nancy Pelosi visited Taiwan in August 2022, defying Beijing's explicit warnings, China responded with unprecedented military exercises surrounding Taiwan with warships and ballistic missile tests. But the military response was only one dimension. In financial markets, analysts began running models. What if China escalates beyond military posturing? What if the next move is financial? The concern was no longer academic. For the first time, the U.S. government began openly discussing the financial dimension of a Taiwan conflict and how to respond to a mass Treasury sell-off. The weapon had gone from theoretical to actively war-gamed. Let's now walk through what an actual execution of this weapon could look like, step by step, in real time. The trigger could be anything. A formal U.S. declaration of support for Taiwan independence, crippling sanctions on Chinese banks, a military incident in the South China Sea that goes too far. Whatever the cause, the People's Bank of China receives the order. Begin liquidating U.S. Treasury holdings. Not gradually, not over months. Now, China's sovereign wealth funds, state banks, and the People's Bank of China begin dumping bonds on the open market. Within minutes, bond traders in London, New York, and Tokyo notice something unusual. The bid-ask spread on Treasuries is widening. Prices are dropping faster than they should be. By the end of the first hour, the yield on the 10-year Treasury bond, the benchmark for everything in the American financial system, has jumped by half a percentage point. That might not sound like much, but in the bond world, it's an earthquake. The Federal Reserve Chairman convenes an emergency call. The Treasury Secretary is already aware. The sell-off is accelerating. The question on the table, do we intervene? The Fed could step in and buy the bonds China is selling, essentially printing money to stabilize the market. But that move carries its own catastrophic risk. It signals panic. It confirms that the U.S. financial system needs life support, and it triggers inflation. There is no clean option. Then, the media catches on. China dumps U.S. Treasuries in historic sell-off. The headline goes global in seconds. What happens next is the real weapon. Not the bonds themselves, but the psychology they unleash. Other foreign holders of U.S. Treasuries begin to panic. Japan, the largest foreign holder, watches nervously. Saudi Arabia, the U.K., South Korea. Each one faces the same calculation. If everyone else is selling, do I want to be left holding the bag? This is the bank-run dynamic applied to sovereign debt. And in the modern era of algorithmic trading, the cascade can happen faster than any human can react. As bond prices fall and yields spike, international confidence in the dollar as a store of value begins to erode. The dollar index, which measures the dollar against a basket of major currencies, drops sharply. A 10 to 15% drop in the dollar index would be historically catastrophic. For context, the 2008 crisis caused a 10% drop over several months. This would be happening in hours. Oil, priced in dollars, becomes more expensive for Americans overnight. Imported goods spike in price. Inflation expectations surge. The bond market, the currency market, and the commodity market are all moving against the United States simultaneously. By day 2, mortgage rates have spiked by 2 full percentage points overnight. Millions of Americans with adjustable rate mortgages face immediate payment shocks. The U.S. government's own borrowing costs have exploded. The Congressional Budget Office begins emergency projections. The annual interest payment on the national debt, already over $1 trillion per year, could double within months if rates stay elevated. Corporate America begins to freeze. Companies that need to roll over short-term debt face rates they cannot afford. Layoffs begin. The stock market, down 15% in 2 days, shows no sign of stopping. The $1 trillion weapon hasn't just been fired, it has detonated. At this point, you might be asking the obvious question, if China has this weapon, why hasn't it used it? It's a fair question, and the answer reveals the most fascinating and most dangerous aspect of this entire story. Here's the brutal irony of China's treasury weapon. Using it would also devastate China. If China sells its treasuries and the dollar collapses, the value of the remaining treasuries China holds also collapses. China would be destroying its own reserves in real time. More importantly, China's export economy depends on selling goods to American consumers. If American consumers are suddenly impoverished by a dollar crisis, they stop buying Chinese goods. Chinese factories go idle. Chinese workers lose jobs. The Communist Party's most fundamental promise to its people, rising living standards, begins to crack. This is the financial equivalent of mutually assured destruction, the same logic that kept nuclear weapons from being used during the Cold War. Neither side wants to fire first because both sides die. For the dollar weapon to truly work, for a mass sell-off to trigger a permanent dollar collapse rather than a temporary crisis, there needs to be somewhere else for the world to go. An alternative reserve currency. Right now, there isn't one. The euro? The eurozone's political fragility, demonstrated repeatedly from the Greek crisis to Brexit, makes it an unreliable candidate. The Chinese yuan? Beijing maintains tight capital controls. The yuan is not freely convertible. The world cannot use it as a reserve currency if China controls how much of it flows in and out of the country. Gold? Simply not scalable for a $100 trillion global economy. The dollar represents approximately 58% of global foreign exchange reserves. The next closest is the euro at around 20%. The Chinese yuan sits at just 2.6%. Without an alternative, even a severe dollar crisis would likely be temporary. The world would be forced back to the dollar, because there's nowhere else to go, for now. Perhaps the most important constraint of all, the weapon only works once. If China fires this weapon and fails to destroy the dollar, if the US and its allies manage to stabilize the system, China has spent its most powerful financial asset. The threat of the weapon is worth more than the weapon itself. Every day that China holds those treasuries without selling them, it holds a gun to America's head. The moment it pulls the trigger, the gun is empty. Strategic patience for Beijing is more valuable than a single dramatic act of financial warfare. But here's what's changed. All three of these constraints are eroding. The world of 2025 is not the world of 2007. The conditions that once made China's treasury weapon too dangerous to use are quietly, systematically being dismantled. For a decade, China has been constructing the architecture of a parallel financial system. The Belt and Road Initiative has drawn over 140 countries into China's economic orbit, creating trade relationships denominated increasingly in Chinese yuan rather than US dollars. The BRICS bloc, Brazil, Russia, India, China, and South Africa, has expanded to include Saudi Arabia, the UAE, Iran, Ethiopia, and others. At their 2023 summit, BRICS members openly discussed creating a new reserve currency to challenge dollar dominance. Most significantly, China has launched the digital yuan, a state-controlled digital currency that can process cross-border transactions without touching the US coin-controlled SWIFT banking system. SWIFT, the global financial messaging network, has been used as a sanctions weapon against Russia, Iran, and North Korea. China is building its alternative. Every yuan-denominated oil deal, every BRICS trade settlement, every SWIFT bypass. China isn't just building a weapon, it's building the escape hatch that makes the weapon survivable. When the West froze $300 billion in Russian central bank assets in 2022, an act of financial warfare unprecedented in modern history, it sent a shockwave through every non-Western capital on Earth. Beijing watched very carefully. The message was unmistakable. The United States will weaponize the dollar against its adversaries. And if Washington would freeze Russia's reserves held in Western banks and bonds, what would stop them from doing the same to China in a crisis? The answer, from Beijing's perspective, was clear. Reduce exposure now, before the crisis comes. This is precisely what China has been doing. Selling treasuries, accumulating gold at record pace, building alternative payment systems. Russia became both a warning and a proof of concept. Here's perhaps the most alarming development of all. China may not even need to fire its weapon. The United States is loading it for them. The U.S. national debt now exceeds $35 trillion and is projected to reach $50 trillion within a decade. Annual interest payments alone have surpassed $1 trillion, more than the entire U.S. defense budget. Moody's, Fitch, and S&P have all either downgraded or issued warnings on U.S. sovereign debt in recent years, events that were once unthinkable. In 2023, Fitch Ratings downgraded the United States from 808 to AA+, the first such downgrade since S&P's historic cut in 2011. Every dollar of new U.S. debt makes the Treasury bond market more fragile. Every interest payment that crowds out government spending weakens America's ability to respond to a financial attack. China doesn't need to crash the dollar, it just needs to wait. While America slowly erodes its own foundation, Washington is not blind to this threat. Behind closed doors, a new discipline has emerged, financial warfare. And the United States is, by most accounts, still the world's most sophisticated practitioner. The U.S. Treasury's Office of Foreign Assets Control, known as OFAC, has turned economic sanctions into a precision weapon. The ability to cut any bank, any company, any individual off from the dollar system gives Washington enormous leverage. But this leverage is double-edged. The more aggressively it's used, the more it accelerates the very de-dollarization it fears. In a Treasury sell-off scenario, the Federal Reserve retains the ultimate backstop. It can buy every bond China sells. Unlimited, in theory. No foreign power can outprint the central bank of the world's reserve currency, but at a cost. Every bond the Fed buys with newly created money is an inflationary pressure. It is a tax on every American savings. It works, but it is not free. The US has also quietly worked to reduce dependence on any single foreign creditor. Today, Japan holds more US Treasuries than China. Domestic holders, American pension funds, insurance companies, banks, hold the vast majority of US debt. Foreign-held US Treasuries represent roughly 25% of total debt outstanding. The majority is held by domestic US institutions and the Federal Reserve itself. China's share has been declining for years. The weapon is slowly being diffused, not by confrontation, but by reducing exposure. And in any real financial crisis triggered by China, the United States would not stand alone. The G7, NATO allies, and major financial partners would coordinate a response, providing dollar liquidity, absorbing excess bond supply, and potentially imposing retaliatory financial measures on Beijing. The effectiveness of this response is real, but untested at scale. Zoom out far enough, and the story is not really about China at all. It's about something much larger, something that has played out before in history, and that history tells us is inevitable. Every dominant empire has had a dominant currency. The Athenian drachma, the Roman denarius, the Spanish real, the British pound sterling. Each one was, in its time, the reserve currency of the world. Each one was backed by the most powerful economy and military on earth. Each one fell, not in a single dramatic moment, but through a slow accumulation of debt, overextension, and the rise of a rival power. The British pound sterling was the world's reserve currency from roughly 1815 to 1944, over 130 years of dominance. The US dollar has held reserve currency status since 1944. The dollar has reigned for over 80 years. And the question that haunts every serious economist, every geopolitical strategist, every central banker on earth is not if the dollar's dominance will end. It is when and how. Will it be a sudden violent collapse triggered by a Chinese financial attack? Will it be a slow, decades-long erosion as the BRICS alternative gradually gains ground? Will America's own debt burden eventually make the dollar unreliable, pushing the world toward alternatives without any enemy action at all? Or will the United States adapt? Will it find a way to manage its debt, reform its fiscal policy, and maintain the confidence of global markets for another generation? These are not abstract questions. The answers will determine the standard of living of every American and billions of people worldwide for decades to come. So, back to where we started. Could China collapse the US dollar tomorrow? Technically, yes. The mechanism exists. The ammunition is real. The scenario is not science fiction. But would China do it? Not tomorrow, probably not next year. Not because Beijing lacks the will, not because Washington has a perfect defense, but because the world's two largest economies are locked in a relationship of mutual financial terror. Each holds the power to devastate the other. And, like all the great standoffs of the 20th century, the balance of terror is, for now, the thing keeping the peace. But balances shift as China builds its alternatives, as US debt grows, as the dollar's share of global reserves slowly declines. As new crises emerge in Taiwan, in trade, in technology, the calculation changes. The day may come when the weapon becomes usable, when one side decides the cost of firing is lower than the cost of restraint. And on that day, whether it arrives in 5 years or 50, the financial architecture that has governed the world since 1944 will face its ultimate test. The $1 trillion weapon is real. The question isn't whether it exists. The question is whether humanity is wise enough and lucky enough to make sure it is never fired. If this video made you think differently about the financial world we live in, share it with someone who needs to see it. And if you want to understand the other hidden levers of global power, the oil weapon, the rare earth weapon, the semiconductor war, subscribe and hit the bell. Because in the 21st century, the most dangerous weapons aren't nuclear, they're financial, and the war has already begun.